Welcome to vTalkInsight, Market Drivers Daily for July 24th, 2026. Energy choke points, renewed tariffs, and a maturing AI cycle are all colliding today, forcing investors to reassess both macro risk and where they are paying for growth. Energy and geopolitics remain the main macro swing factors as we head into the weekend. Brent crude has spent much of the past few sessions around the $100 mark after a surge of more than 30% over the month, and at one point closer to 40%. Compared with earlier this week, when refined product tightness dominated the story, attention has swung back to U.S. Iran tensions, new tariffs on around 60 economies, and fragile shipping routes, all of which are encouraging a more cautious stance in risk assets. The key concern is that supply is vulnerable at several choke points simultaneously. Disruptions in the Strait of Hormuz and Bab el-Mandeb are already constraining crude flows, while potential closures would severely affect Saudi exports into Asia and delay cargoes rerouted around Africa. This is happening against a backdrop of low global inventories and high refinery runs. U.S. strategic reserves have been drawn down, refinery utilization is in the mid to high 90s, and Europe faces gas futures in the 60 to 70 euro per megawatt hour range with storage just above half full, leaving very little buffer if Middle East risks escalate. These energy shocks are now colliding with policy and inflation dynamics. Rising oil and gas prices, plus new U.S. tariffs in the 10 to 12.5% range, are lifting input costs globally and complicating central bank plans to sit on hold. Officials in the U.S. are increasingly worried about inflation pressures from energy, tariffs, and AI-driven demand, with a rate hike as soon as next week now seen as plausible. In Europe, expectations have firmed for one more European Central Bank move in September, framed less as the start of a new tightening cycle and more as insurance against another round of energy-led inflation. There are, however, important offsets that are keeping a full-blown oil shock from becoming the base case. Brent has dipped back below $100 at times. Energy stocks in Europe are under pressure as prices retreat from the highs, and record demand for Brent put option signals that many traders see meaningful downside if there is any de-escalation. U.S. gasoline and fertilizer prices have also shown some resilience despite the geopolitical noise, and a large-scale U.S. blockade in the Red Sea is viewed as unlikely given limited strategic value. For portfolios, the key watch points now are weekend headlines around U.S. Iran decisions, any fresh disruption near Hormuz, the evolution of tariffs and retaliation risk, and how quickly central banks lean against this energy-driven inflation pulse. The AI story is still the dominant structural growth theme, but the questions have shifted from how big it can get to how it will be financed and monetized. Persistent high capital spending on AI is now a macro driver in its own right, contributing to higher real yields alongside energy and tariff shocks. Credit markets are increasingly focused on whether the AI infrastructure cycle is sustainable, with recent sector-specific volatility and wider spreads reflecting unease that the pace of spending may be running ahead of visible cash returns. Beneath the surface, the real economy impact of AI is broadening beyond a handful of U.S. megacaps. Intel is seeing its fastest revenue growth in nearly 15 years as AI workloads shift from model training to deployment, driving renewed demand for general-purpose CPUs and foundry services, with strong guidance stretching out to 2027. Enterprise software names like SAP are beating expectations on cloud and AI-enabled revenues, while AI-linked hardware and infrastructure plays, such as Micron and data center operators, continue to benefit from heavy order books. Even mid-cap industrials and large tech-enabled retailers are participating as they supply equipment, logistics, and automation that underpin the build-out. The flip side is that much of this AI boom is being funded through debt. Tech companies have issued well over $200 billion of debt tied to infrastructure plans this year, and investors are demanding higher risk premiums, particularly from hyperscalers whose free cash flow is being squeezed by massive data center projects. Recent investment-grade deals linked to AI data centers have been less oversubscribed than in prior years, and spreads for some AI-focused issuers are widening. Bond investors are increasingly insisting on clearer visibility around returns on capital, not just headline earnings growth, which raises the risk of a more abrupt capex slowdown if financing conditions tighten further. competition and policy are adding additional layers of complexity to the AI theme. Large language models are becoming more commoditized, with no single provider expected to dominate enterprise demand, pushing vendors to differentiate through control of business context, data integration, and flexible use of multiple models to manage token costs. At the same time, the race between U.S. and Chinese AI ecosystems, plus concerns over cybersecurity and rogue AI agent behavior, is spurring both regulatory debate and a surge in corporate security spending. From a market perspective, the next phase of this cycle will likely be judged on how management teams balance growth ambitions, capital intensity, and risk controls rather than on model benchmarks alone, setting the stage for the valuation debates we turn to next. With geopolitics unsettled and AI, capex, surging, valuations are sitting in a fragile equilibrium rather than at clear extremes. In technology, sector price to earnings multiples have already fallen from around 32 times to roughly 23, and the premium over the broader market has compressed from about 45% to close to 10. At the same time, elevated 10-year Treasury yields near 4.7% mean the cost of capital is not easing. A move to 5% could, on current estimates, push S&P 500 multiples down toward the high teens, even if earnings hold up. One clear sign of stretched expectations is how stocks are trading after results. Around 85% of companies are beating earnings forecasts, yet many shares are selling off on the day, suggesting good news was already fully priced. High-profile examples range from American Express, where a revenue miss and a 10% jump in expenses have raised questions about the sustainability of its premium valuation, to AI-linked names where even strong cloud or data center numbers have not prevented sharp corrections, including a near $1 trillion drop in the so-called Magnificent Seven's market value this week. Concerns are most acute where heavy AI spending, debt financing, and rich multiples intersect. A significant share of AI investment is funded by borrowing, and investors are questioning whether current capex can deliver sufficient returns before higher rates and input costs bite into profitability. Base case downside risk for equities is being framed around 7 to 8%, but several analyses warn that if financial stress emerges from interconnected AI investments and bond markets lose patience, drawdowns could be materially larger. That said, semiconductor valuations remain well below late 1990s levels while earnings are much stronger, arguing against an outright replay of the dot-com bubble. Under the surface, dispersion is opening up new valuation questions across sectors. Defensive areas such as staples and pharmaceuticals are trading at deep discounts, while many AI-related stocks have already fallen 15 to 20%, compressing some of the most stretched multiples. European banks now offer dividend yields around 7% with very high payout ratios, presenting an income-rich alternative to U.S. megacap tech, and some investors see software and hyperscaler names as potential value only after the recent reset. The key signals to watch from here are long bond yields, credit spreads around AI issuers, and whether upcoming earnings can support the still optimistic assumptions embedded in equity prices. To sum up, energy choke points, new tariffs, and the prospect of further central bank tightening are keeping inflation risks and volatility elevated, even as oil occasionally slips back below triple digits. The AI build-out remains a powerful growth engine, but it is now colliding with higher funding costs and rising scrutiny over free cash flow, making credit spreads and capex guidance crucial markers for the next phase of this cycle. Valuations have already adjusted from their peaks, yet markets still price in a near-perfect combination of strong earnings and contained macro shocks, leaving limited room for disappointment. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.